Welcome everybody to Fidelio's webinar, Boards and Climate Change, What Boards Need to Know. Amy, if we could flip to the first chart, thank you. Fidelio's focus is building better boards, and climate change is very much part of that equation. There's been much discussion about the contribution that companies need to make, but there are also many things that board directors need to know. And that's the focus of today's webinar. If we can move to the next chart, please. Obviously, there's been tremendous coverage about climate change and a great clarion call with Greta Thunberg, David Attenborough, and most recently, Bill Gates. And while Bill Gates has highlighted that innovation has to be part of the solution, he's also put his finger very much upon some of the governance issues and the ethical issues surrounding climate change. Is divestment enough? It can't be. And what does a fair transition look like? And indeed, this starts to raise questions about how ready are boards for climate change? If we move to the next chart, please, Amy. Many of you will have read recently in the Financial Times a very damning article saying that too many boardrooms are climate incompetent and arguing that only 7% of board members were qualified or knew enough about climate change to understand how it could affect their business. Within Fidelio, we see things slightly differently. We absolutely agree that there's a tremendous learning curve, without a doubt. But if we look, for example, at the search side of our business, we see a very strong interest at board level in the sustainability committee chair role, and at executive level in the head of sustainability role. And this interest is without a doubt picking up. Equally, and here full disclosure, I'm a steering committee and board member of Chapter Zero. But if we look at the work of Chapter Zero and the Directors Climate Forum, we see very, very strong interest among non-executive directors, recognising that climate change competence is becoming a core board competence. It's an important board skill. Equally, if we look at the evaluation and development work that Fidelio is doing, every board evaluation has a strong ESG and climate change component. And the board learning modules that are very much in demand focus on, for example, ESG 1721 reporting and the ESG leadership grid. So we would see things slightly differently. We see a steep learning curve, but a tremendous appetite for more information and a better understanding regarding climate change. Next chart, please, Amy. But I'd like to now, before we come to our excellent speakers today, I'd like to turn to the audience and just conduct a poll. So does your board have a good grasp of climate change risk? And A, yes, my board is well informed, alert to the risks and able to prepare. And B, no, my board underestimates the disruption and business model risk that climate change presents. So we're just waiting for the poll results to come in. We'll just there we go. I think we'll stop there, Amy. And could we just read out, we seem to have 61% consider their board to be well informed and alert to the risks, and 39% feel that the board underestimates the disruption and business model risk that climate change presents. Well, we won't run the poll at the end of the webinar, but maybe we should to see whether those proportions, I must say I'm quite surprised by the 61% and pleased, but let's proceed with the webinar. And if we can move to the next chart, please, Amy. So joining us today, we have a panel of experts to focus on climate change risk, what board directors really need to know. We have two partners from Clyde & Co, Laura Cooke and Simon Konsta. I've spoken on a podium with both before on some of the risks relating to climate change, and I think it's just a very important framework, that legal perspective that we often sort of skip over. And we're also joined by Sydorowitz from Georgeson, who will bring us up to date on the AGM season and what investors are looking for with regard to climate change. So I'd like to start with Laura, and Laura's going to share with us a framework, a sort of a legal framework, and I am aware this is going to be a little bit of a canter through. I should say there will be plenty of opportunity for questions at the end. So if you do have questions, please do send them through on the Q&A function. Laura, if I can hand over to you.
I hope I'm unmuted. So hello, everybody. As Gillian said, I'm just going to give you an overview of the legal framework here in the UK, which is pertinent to the directors' considerations of climate change issues. Without wishing to be alarmist, I thought I'd just quickly kick off with a brief overview of some analysis of climate change litigation internationally, and just to give you an idea of what that's looking like in terms of focus and jurisdictions. But obviously, climate change related litigation, it's still an emerging and evolving area, and it will vary considerably across different jurisdictions. One of the leading sources of information, cumulative information about litigation which touches on climate and climate change related issues, is maintained by the Columbia Law School. There was some analysis done on their data mid last year by a entity within the LSE here in London. And it showed that between 1986 and May 2020, so it'd be nice to have it slightly more updated shortly, the vast majority, in excess of 75% of climate change related litigation was within the US. Most of us probably wouldn't be too surprised by that fact. But outside of the US, the majority of cases were brought in Australia, then the UK, and then before various EU bodies and courts. I think it would be fair to put these types of litigation and cases into three broad categories. The first is administrative, where they are cases against governments, public bodies, with the aim of challenging decisions, influencing conduct or policy. And I think, again, the vast majority of the ex-US cases tend to be in this category. But in addition, we also have tortious-based claims against corporations alleged to have been perpetrators of climate change, so failure to mitigate type of cases. Additionally, still, claims are beginning to arise brought by investors and regulators against corporations, and in certain circumstances their Ds and Os, for failing to take account of the possible risks to climate sensitive, carbon intensive assets, failure to take account and for disclosing risks to business models and value chains when reporting. So I think at the crux, what we're talking about when we're looking at potential obligations and risks for companies and their Ds and Os are these three: failure to mitigate, failure to adapt, and failure to disclose. Now, moving to the UK framework, as knowledge of climate risk grows and greater information and standards develop, it will become increasingly important for directors and officers to demonstrate that these risks have been considered, actions being taken to mitigate, and values assessed on assets and disclosed appropriately. As to whether challenges could be brought against Ds and Os under existing legal duties in the UK, attention has naturally been focused upon the existing duties under the Companies Act. As you'll all know, absent insolvency, directors owe their duties to the company. And it's also important to note that the Companies Act does not draw a distinction between executive and non-executive directors, albeit in practice, their roles will differ and what they have to do to discharge those duties will likely be different. Now, whilst recognising the point has not been tested in the UK courts, there are two particular duties which are sort of being focused upon and discussed as potential routes through to directors in respect of climate change failings. For example, a failure to assess, manage and report on foreseeable and material risk of climate change. The first is section 172, And as you all know, that requires a director to act in a way which he or she considers in good faith would be the most likely to promote the success of the company. And in doing that, they have to consider various issues, which, amongst other things, includes the impact of the company on the community and the environment. So the language of that duty necessarily lends itself to ESG considerations. And additionally, as again, I don't think will be particularly controversial, the duty to exercise reasonable care, skill and diligence. And within that will obviously include sort of informing and educating oneself on issues relevant to your company. It is one which there is a focus on. Now, another developing area, which obviously is probably more relevant to what Kaz is going to speak about after me, is the focus on liability. It's a focus on possible liability of companies and their Ds and Os for alleged failures to take account of and disclose climate change risks. Well, the question is then, well, what are those standards? And you're all probably aware of the Task Force on Climate Change Related Financial Disclosures, TCFD. That's very much leading the way, but it's certainly not the only reporting framework that's out there. But it's certainly the reporting framework of choice of the UK government. And in November last year, it was announced that the government wanted to make it mandatory by 2025 for large UK companies and financial institutions to make TCFD compliant reporting. So that would be mandatory. This was a really interesting announcement, and it was accompanied by an interim report and roadmap from the UK's own TCFD task force, setting out an indicative path for implementing mandatory disclosures, many of which, at least it's proposed for now, will come into force in 2023. Interestingly, the next day, the FRC actually published a thematic review, which set out its review of climate-related considerations for boards, companies and auditors, also professional bodies and investors, and its review of the quality of those disclosures, what needs to be done more. It's a really interesting read. But most pertinently, in December, the FCA confirmed that it would be introducing, with effect from the 1st of January this year, a new listing rule which requires large UK companies and premium listed companies to comply or explain why it's not complying with TCFD. So this is a real key change in that and sort of point in that move towards mandatory disclosure, and the FCA has confirmed it's going to be consulting on how it may broaden out that requirement onto a larger number of companies during the course of this year. Interestingly, with that listing rule confirmation, the FCA also published a thematic review which gave clarification on the extent to which existing requirements applicable to all listed companies already require climate and other sustainability related disclosures where they are financially material, or in certain other circumstances subject to, with reference to the listing rules, disclosure and transparency regulations and the market abuse regulations. I think we also have to have a mind for the Section 172 statement, which came into being for a much broader grouping of companies pursuant to the Companies Miscellaneous Reporting Regulations in 2018, which requires a company to explain how the directors have had regard to the matters in Section 172, so obviously including that environmental aspect. In terms of other sort of relevant offences, and again, not wishing to be alarmist, but causes of action that maybe for want of a better word, already on the statute books, which are relevant to disclosure issues. We obviously have certain civil and criminal offences relating to false and misleading disclosures in a corporate context, which directors can be subject to. That's Section 463 of the Companies Act, Section 89 of the Financial Services Markets Act. But also we have a regime, Section 90 and Section 90A, which are relating to, again, misleading statements and omissions for Section 90 IPO documentation, listing documentation, and in general statements under Section 90A. So there is a lot that's already there. I think we also need to remember that in certain specific industries, for example, regulated industries, there might be additional obligations on directors. I'm thinking particularly financial services. And I haven't even had the opportunity to touch on carbon and energy related reporting, which has obviously again come in relatively recent times for large companies. But as I say, a very quick canter through. And I think it's now time for Kaz, but I'll pass back to Gillian first.
Thank you, Laura, very much indeed. And that was ambitious, and I appreciate you giving us such a sort of a good grounding. And some of those themes, particularly around reporting and disclosure, I think will come up again and again. So I'd like to now hand over to Kaz Sydorowitz. And Kaz has, we've collaborated with Kaz internationally on a number of governance issues. And I've asked Kaz today to take us through, what investors are looking for and where we're seeing those flashpoints between investors and companies. So Kaz, if I may, over to you.
Thank you so much. Just a very quick summary for the 2020 meeting season, because there's a couple of interesting developments. First off, participation. FTSE 100 shareholder meetings, actually the quorum levels, the participation went up. That was a surprise for us, as we were expecting, as most of the institutional investors working from home were coming to grips with the new reality, that we'd see that participation go down. So this year it was 74.9, last year was 73.8. I think we will actually see those levels continue, at least at the same level as this year, and perhaps even increase in 21. The more important issue is, with more virtual shareholder meetings, I would expect to see more institutional attendance than we've seen in the past. It's far easier for them. They can do so at the convenience of their office, their home, without having to get up. So it's an important development, which we actually would anticipate seeing more of. Shareholder opposition in the FTSE 100, the issues that garnered the greatest opposition came from focused on director elections, followed by the authority to issue shares, and then, not surprisingly, the remuneration policy and report as well. There was a 15% increase in contested director elections last year. So watch that space, as all of you on the call are looking at, elections, understanding who your shareholders are and what's driving their decisions. Is it their own governance policies? Are there other trigger points for them? Are they being guided by ISS and Glass Lewis? The next key development that we saw last year was the number of activist campaigns was down significantly last year. We're starting to see a reversal of that in the tail end of last year, the beginning of January, with more and more activists coming, looking at targets, looking at the valuations of those companies, and starting to realize that they can build a stake, if they haven't already, over the past year, and sue for change in terms of their demands. Let me quickly go into looking at next year, or the year we're in, actually, 21. It's remarkable. There's been a slew of shareholder letters that investors have written to their portfolio companies, the most famous of which is the Larry Fink letter from BlackRock that came out in the end of January. State Street Global Advisors wrote a letter from their CEO. In the UK, Aviva investors written to their portfolio companies, along with Capital Group and Vanguard. And one of the things that we're seeing time and time again in these various correspondence, we see these because many of our clients share them with us in terms of understanding what their red line issues are and what points they need to be prepared for in the coming meeting season. The first point is diversity, equity, pay equity, and inclusion, DEI. It's another 3-letter acronym that I expect we'll see more of in the year ahead. Now, interestingly, and related to that, Norges Bank just published a position paper on board diversity yesterday, saying that directors should have a diversity of competences and backgrounds. This year, it's going to target companies in developed countries with fewer than 2 female board members. All companies with less than 30% female directors should consider having a target to boost the number. So Norges Bank is reportedly to have approximately 1.4% of every company on on the planet. So Norges Bank is likely to be in your shareholder list. And it's important to kind of understand what impact they may have in your own resolutions coming up. ISS and shareholders are looking for diversity within the boardroom and the wider management team. Solely looking at the board was probably as important last year, but this year it's starting to expand and consider the wider management team, and in some companies, depending on the sector, the entire employee base. Diversity is being defined more broadly than pure gender diversity, and for those companies who don't have a diverse board and management team, shareholders are looking for policies on how to improve those numbers. So even if you're not addressing that this year, you will be expected. You should consider what your policies are to address that going forward. ISS has interestingly acquired a cybersecurity business, and so they've added cybersecurity experience on the expectations that they want from companies. Clearly, there's a rationale as to why, but it happens to be a pet project for them, largely because of the recent acquisition they've made. There's also a focus on ESG on companies, both those directly involved in oil and gas and extractives and power companies, but also in the wider space, looking at banks and insurance companies. And I'll come on to a couple of examples in that space. ISS updated their policies at the beginning of February, recommending votes against company directors over material failures, including demonstrably poor risk oversight of environmental and social issues, including climate change. So the proxy advisors are addressing this, shareholders are addressing this, and we're even seeing some investors pick up these issues directly and focus on them. So Chris Hahn from TCI, many of you have heard of, ran a campaign at the Spanish airport group AENA last year in November, looking to put forward global warming, the company's plans to tackle global warming to shareholders vote at their annual meeting, and they were successful and the resolution passed. TCI is also getting success and traction at Moody's in the United States and other portfolio companies of theirs, but expect other investors, traditional investors, as well as these activists, putting pressure on companies to address these issues. Chris Hahn and TCI can do that because he has 12 or 15 names in his portfolio. And so he's spending an inordinate amount of time making sure that his portfolio companies are addressing global warming, and so they don't have stranded assets or are worse off as a result of the wider climate changes that are being enacted from a regulatory perspective. Share Action has launched a campaign at HSBC this year. They want HSBC to publish a strategy and targets document, reducing its exposure to fossil fuels through lending and funding projects. First, looking at coal and looking at other issues. HSBC is Europe's second largest financier of fossil fuels after Barclays. Share Action ran a campaign last year against Barclays, so it's not really a surprise that they're targeting HSBC this year. And this is an example of companies not directly involved in, a company that has a large carbon footprint themselves or responsible in their day-to-day activities, but is related to the sector because they are funding these projects. So it's not only happening with investment banks, it's also happening with insurance companies. There's a number of shareholders as well as NGOs who are going after insurance companies. Besides TCI, which has kind of made a name for themselves, and I think they are very early to this game. In my opinion, I think part of their efforts are to drive an inflow of funds. TCI manages $30 billion of assets under management, and they want to grow those assets either to 35 or 40 billion. And they're doing so by focusing on climate related issues. There's 4 other activists that have either just started or are already running, focused on ESG issues. I won't go into all of these names in great detail, but you should just be aware of them in case you receive correspondence from any of them or you see them on your share register. The first one is Clearway Capital, run by Gianluca Ferrari. He was an activist sitting in Germany at another investor who's just created Clearway with a focus on ESG issues. Engine One, run by Chris James and Charles Penner. They come out of JANA Partners in the US. Engine One is famous right now for running a campaign at ExxonMobil. They themselves, Engine One, are backed by CalSTRS, so they have long-term capital behind them with a multi-year horizon. The other two names, one is Inclusive Capital Partners. This name is relevant because Jeff Ubben, formerly from Value Act, spun out of Value Act to create this business, and it's very much focused on sustainable businesses, and he is happy to invest in companies that may have a high exposure to a large carbon footprint, but that are being abandoned by other investors who are looking to divest. Impactive Capital, founded by Lauren Taylor Wolfe and Christian Asmar from Blue Harbor Group, are also looking at this. They actually have an investment in Equinity in the UK. So they're not only US focused, they're looking internationally. And then I'll just end with a few names that are relevant, because activism is not only being promulgated by the names I've mentioned and the likes of TCI, they're also being put forward by NGOs who've taken up issues either for carbon emissions reporting, or financial services companies. So Share Action, the one who's gone after Barclays last year and HSBC, they've gone after a number of companies in different jurisdictions. Climate Action 100, they've looked at the largest 100 carbon emitting companies around the world, and they've written to them looking for greater transparency and a higher degree of reporting on what they're doing to address their carbon footprint. Follow This has done a number of campaigns internationally. Unfriend Coal is very much focused on the insurance sector, trying to stop insurance companies from insuring miners taking coal out of the ground, or power companies who are burning that coal to generate energy. By making the cost of running or extracting the raw materials, causing those fees to go up, those costs to go up, they're trying to make it uneconomical for these organizations to mine the coal in the first place or to burn it for power generation. And then I'm sure everyone on this call has heard of and seen witness to Greenpeace and some of their activities. It's less impactful now that we're all working from home, because in a virtual meeting environment, how are they going to protest and kind of disrupt? I would expect in the world of virtual meetings and hybrid meetings for cyber attacks to become more relevant. We've not seen that yet, but this is a fairly new transition to this new technology. Let me pause there, and I can come back and in questions later on.
Thank you, Kaz. A number of themes there, and gosh, how rash sort of saying that we haven't seen much sort of cyber attacks or whatever while we're hosting a Zoom call. And I did note the sort of the catalogue of activists on that diversity, all male again, but there we go. Coming back to our main theme today, thank you very much, Kaz. That's really helped us sort of set the scene again in terms of the market pressures on board directors. And I'd like to come to our final speaker now, and that's Simon Konsta. And Simon will take us through some of the things that you as a board director personally should be thinking about in this constellation that we've just talked about, the legal framework, the market pressures in terms of boards and climate change. Simon.
Thank you very much, Gillian. I'm conscious you want to leave good time for questions and answers, so I'll whip through, but this is an enormous topic, and the greatest challenge is to reduce it to something that is meaningful in this context. But what I wanted to do, having listened to Laura and Kaz is maybe, as you say, put a little bit of context around some of the issues that are being discussed. And the first one is the difficulty, if you like, the complexity and just the nuanced decisions that companies are going to need to take as they look to transition their businesses in the lower carbon economy, and how that is fraught with pitfalls and prone to missteps, and how this is all happening in an environment where there is ever increasing liability risk, ever increasing expectations in terms of standard of care around the globe, both in terms of driving policy change, but also in terms of, frankly, recovering compensation and hawkish claimants out there. So I'd like to just take two initial examples of that that really look to the complexity and difficulties of the decisions and predictions and the materiality that transition may have on balance sheets and company strategies. The first is the concerns GE's acquisition of Alstom's gas turbine operations in 2015. GE's thinking at the time was that natural gas was the next staging post as power companies looked to transition away from coal power. And they acquired Alstom's gas turbine operations for about $10 billion. But within a relatively short period of time, it was clear that the business was underperforming. And by 2018, so a very small number of years, GE was driven to write off over $23 billion, of which a substantial proportion related to the underperforming Alstom gas turbine assets. And commentators at the time attributed this write-off to GE effectively having misjudged how quickly the growth of renewables was going to impact gas turbine pricing and lead to a sharp reduction in demand for gas turbine power. So that is, if you like, a perfectly understandable but classic example of how transition risk can impact asset values and potentially share price and everything that goes with that in terms of corporate and board exposures. The second is the events of around a year ago relating to BP. Early in last year, BP announced its ambition to become a net zero company by 2050, and it wanted to develop its strategy to create a more resilient, lower carbon energy company. And of course, there's been a lot more written about that and said about that in the intervening period. But for current purposes, shortly after that announcement, of course, we were plunged into the current COVID pandemic. And having appraised the consequences of that and the overall position, BP concluded that the pandemic was going to have an enduring impact on the global economy with the potential for weaker demand for energy for a sustained period. And BP's management also had a growing expectation that the aftermath of the pandemic would accelerate the pace of transition to a lower carbon economy as companies sought to build back better, a phrase that we've become much more used to. And as a result, it revised its long-term price assumptions, lowering them and extending the period covered to 2050, so that the price assumptions were consistent with its net zero horizon ambition. And this and some other package of measures led to a non-cash impairment charge in the second quarter, estimated to be around $17.5 billion, and Shell followed suit very shortly thereafter. So just two examples, one from power, one from energy, but you could apply it in different degrees to companies and other sectors where, but both sort of demonstrating the potential for managing that transition risk to have a very material impact on the balance sheet and performance of companies across all sectors effectively. Laura was talking about TCFD and the increasing sort of mandatory nature of that. I just wanted to really dwell on the practical difficulties that the truth is, although TCFD is being adopted voluntarily by many businesses, probably only 3 or 3.5 of the 11 set questions are being, or a specific disclosure are being properly addressed. So there is really quite a lot of further work that needs to be done. And although it's a European issue, it applies, I think, equally to the UK. In December last year, i.e. 2020, the Climate Disclosure Standard Board issued a report on the state of EU environmental disclosures last year, having reviewed the environmental disclosures of 50 of Europe's largest listed companies with a combined market cap of over $3.5 trillion under the EU's non-financial reporting directive. And the review indicated some ground for optimism with improvements in aspects of disclosure relative to the 2019 review. But it also concluded that the existing regime of voluntary TCFD adoption means that companies continue to take a selective approach to disclosure. And the report urged explicit inclusion of TCFD recommendations into the non-financial reporting directive as being a necessary requirement to achieve appropriate and full disclosure such that appropriate investment decisions could be taken. So it demonstrates that whilst the regulation and statute is driving us, the practical ability to comply and compliance is lagging somewhat behind. Moving slightly more closer to home for current purposes, and another indication of how duties and responsibilities in the environment is changing was the announcement a couple of weeks ago of the proposed but frankly long-awaited government white paper on the wholesale reform to audit and sort of Sarbanes-Oxley type changes to directors' responsibilities, primarily to hold them more personally accountable for companies' financial statements. And the driver for that, as we all know, were various reviews conducted into the lack of fitness of audits and also ongoing concern over accounting scandals. But the relevance of that white paper, which was supposed to have come out last week and sadly hasn't, I'd love to be able to talk about it. But when it does come out, the relevance will be in the context of climate change, that it suggests that there will be new rules to report on environmental and social obligations, such as climate risk, and potentially an extension of the definition of public interest entities, which at the moment is predominantly confined to listed companies, to include large private groups, charities, and universities. So combined with greater personal accountability, seems to me this is the clearest indication of the direction of travel, and the need for clarity around ownership of climate risk at board level, and also a careful assessment of your personal exposures comes firmly into sight. And in that regard, we also know, and it's an issue that's been raised in the context of this proposed white paper, we also know that there's been alarm about increasingly hardening D&O rates. And if we have this increased sort of personal accountability and overall enhanced disclosure obligations, is that going to lead to the potential uninsurability or unaffordability or restricted terms on directors and officers insurance cover, which could kill the goose that lays the golden egg in terms of getting expertise and skill of the appropriate caliber into the workplace, so into the boardroom. So two other things I'm going to mention very quickly. You may have noticed last week a Supreme Court decision following on from the Vedanta decision, which looked at the alleged environmentally damaging activities of Shell's subsidiary in Nigeria, which precipitated a claim by inhabitants of two specific areas of Nigeria against Shell's holding company on the basis that it was effectively directing affairs and should therefore be directly responsible and accountable for the activities of subsidiary. The Court of Appeal had dismissed the case at an interim level on the basis of, corporate veil, etc., and honouring the jurisprudence of corporate veil. But what was really interesting is that the Supreme Court has reversed that and has remitted the case back as effectively a tribal case against the Shell at a holding company level. But the real point here is that what is today effectively an environmental complaint on the part of these inhabitants, looking to cut through carefully crafted ownership and legal structures within this conglomerate's business, could so easily be climate related in so many different ways tomorrow. So we need very carefully to watch that space in terms of deep pocket litigation, embroiling corporates and embroiling boards. And my final observation, although I could give many, many more, was a decision a couple of weeks ago in France, which followed on from the agenda decision in Holland last year, namely holding the French government, and before that the Dutch government, accountable for its Paris-related climate promises, and requiring it to take steps to comply with its climate-related promises. That case went in favour of the activists effectively, as did the gender case. In May, I believe there will be a hearing in respect of, and I don't want to focus on Shell particularly because they're doing a lot of very, very good things, but there is a case in Holland, I believe, brought against Shell looking for direct personal reparations against that entity, as opposed to government entities. So, Gillian, those were just some of the things I wanted to set out as being part of this sort of burgeoning environment that we think that boards and companies ought to be taking very seriously.
Thank you very much indeed. And Amy, if I could ask you just to perhaps drop the charts as we move to Q&A. And we've got a number of questions coming in already. So if I can perhaps start with a question that's come in relating to just the number of successfully brought cases that I think Laura sort of outlined, that there's been a lot of activity, but how many have actually resulted in successful cases being brought against companies and directors? So perhaps Laura, if we could start there, please.
No, quite right. I think it obviously would be fair to say that a lot of them have not as yet been materially successful. I think if we first look at the tortious types of claims which are on foot in the US, they're often seeking damages predominantly against fossil fuel companies, and they tend to be framed in terms of public nuisance and sometimes negligence, trespass, and sometimes actually more recently, more creatively, as product liability claims, i.e. the fossil fuel was defective by design, for example. So I think with the plaintiff bar, and I think if one draws a parallel to maybe the asbestos and tobacco litigation of yesteryear, it often took a number of years and a number of attempts for the liability sort of framework to be properly set out. With most of these cases, it's causation that is the stumbling block. And I'm certainly not going to suggest that I'm a sort of climate scientist, but as climate attribution science develops, it may well be that issues of causation become easier to overcome. So that's on the tortious side. Just touching on the more of the administrative types of cases, and Simon just alluded to a recent French case and the Dutch case. Some of these administrative cases do tend to be more successful, and a particular issue that is starting to come up in those is around human rights, and particularly in the European context, the European we've got the Netherlands gender case and a French case, and there's been one recently in Ireland last year where, again, the governments are being held to account to their promises. So those are really interesting. I think the attendant who posed the question also mentioned Germany. Well, obviously, there's quite a lot. If one looks at Dieselgate, for example, I mean, we've got environmental law breaches, we've got disclosure breaches, we've got criminal sanctions, we've got shareholder class actions. There is a lot that has been going on there, but there's also, and interestingly, on the tortious basis, there is a very long-standing case against RWE, one of the biggest German energy suppliers, in relation to climate change damage in Peru. So we've got very interesting causation arguments there. But that has been deemed to be a triable case, and we're waiting for that to progress as well. So I think in the whole, not some of, on the tortious basis against companies and directors, and also obviously looking at the disclosure, I should obviously mention the New York Attorney General's case against Shell in relation to their disclosures, which I think, to be fair, crashed and burned, and is seen as quite, was not very successful from the Attorney General's point of view. But there are other cases like that that are still going on. There's still shareholder class actions and ERISA actions against Shell. So some are doing better than others, but we'll just, so watch this space.
Thank you. And could I ask a question of Kaz? Kaz, you set out the sort of the landscape of activism that's building up in terms of climate change. You also mentioned that I guess ESG is quite a good marketing tool and it's a good way of attracting funds. I'd just be interested in your view, how focused and dedicated and how much teeth does this form of activism have, and how much is it a marketing tool, as you suggested?
It's an excellent question, and I think that we're in the midst of a gold rush of asset managers, whether it's TCI or any of the other names I mentioned, to capture a greater percentage of the allocated funds for their pension fund clients, endowments, and so forth, who are now looking at socially responsible or impact investing allocations. And so I fully expect that a large part of this is being driven by an effort to capture those funds. Don't forget, activists get paid on a 2 and 20 pay model, 2% of assets under management and 20% on the P&L of any trade that they're focused on, an activist campaign. So where they make their most money is increasing value, whether it's a divestment of a business or paying a special dividend. But to keep the lights on, they charge 2%. To their investor clients. And if CalSTRS with Engine 1 is signed up for a 6-year term. So I don't know if their fee structure is 2%, but that's 2% for the totality of their 6-year period, plus the success fee on any of the activist campaigns. I think right now it's a bull market for shareholders claiming that they have an ESG focus so they can grow their assets under management. And part of the reason that's happening right now is all of these allocations are looking for these pools of funds. Their actions, so Engine 1 is looking to put additional people on the board of ExxonMobil as one live example right now. The activist demands will largely focus on disclosure, transparency on certain policies, and board representation. I don't imagine it being much more dramatic than that in the immediate term. It may evolve and take the line of TCI, but I'm not sure that we'll see that even in 21.
Thank you. And certainly, as you mentioned, as a marketing tool, it's a very effective marketing tool. So, thank you, Kaz. Simon, I'd like to address a question to you, and perhaps bringing two themes together. You mentioned, I guess initially, the focus has been on quoted companies, and hence, I guess, sort of Kaz's comments about what's happening in the markets. But you mentioned the sort of extension of liability and responsibility to directors of privately held companies and charities, and we're getting quite a few questions on this subject. So would you be able to just perhaps expand and provide some clarity for all those who are on our call who are sitting on not just quoted company boards, but other forms of boards as well? Simon.
Yes, well, I mean, I would say that Laura is an expert in the pensions world too, and of course, pension trustees have got their own rules and regulations around climate. But leaving that to one side, the truth is that this white paper is a white paper. It's not written in stone, and I think we will be looking at least 2 to 3 years before anything were to become law as such. And secondly, there will be a very significant debate around the speed of transition and the degree of personal accountability that might lead to, and the potentially adverse consequences of that. So, in short, I'm sure that there is a direction to travel that the government is set on, which is to broaden out to universities, to charities, and to larger private corporates the maximum sort of climate-related disclosure, etc. But I also think that there is a recognition that you can't just move too quickly. These are, as I said, these are difficult, nuanced and complex decisions. And if you force the pace of change too quickly, you will get bad business decisions, and that's not good for anybody.
Thank you. I've got a couple of questions which I'm going to perhaps open to all our panelists. One just on transition risk, how nuanced? I mean, we've talked about some of the sort of the pressures in the market. We also started with that quote from Bill Gates about, divestment alone isn't an effective tool and it's not going to solve climate change. But how nuanced do you think that the whole debate and discussion is on around transition risk, given that many companies and boards of directors might argue that not divesting and nurturing an asset is the way to develop, whereas from an investor perspective it could become a stranded asset. So I open that really to all our panelists. I don't know who'd like to kick off on that. I mean, Kaz, do you have a perspective on transition risk?
I have an element that I'd like to contribute to this question, and it has to do with the various ESG rating agencies that are guiding many of the investors in terms of their stock selection, their portfolio screening. And unlike debt ratings, there aren't dedicated analysts who cover specific companies. And so what you see is gaps emerging between companies and these various ESG ratings, where they produce ratings absent a discussion with the company, and increasingly being the data that's being captured to produce those ratings is being generated by artificial intelligence and robotics. So just making the curation of the data, the validation of it, that much more difficult. And if it's all done in a vacuum without the issuer's oversight or visibility on that, it can create perverse outcomes. And so I think as we talk about this transition, investors are recognizing that some of the data providers, they may all cover the same companies, but come out with completely different ratings, that they have to address this by looking at the data themselves and identifying what's important, and making sure that those investors plus the ESG rating agencies are communicating openly with the issuer community about what they expect, what metrics should be included, and at what points in time for them to produce their own scores and information. And equally, that there's a dialogue about those results, so it's not just done in a vacuum.
Thank you very much. And we are getting a lot of questions about exactly that topic, reporting frameworks. I know both Simon and Laura talked about TCFD, but we've been asked about the broader picture about reporting frameworks. And I don't know if either Simon or Laura would want to add a comment on, where we stand and where we're likely to settle in terms of either recommended or statutory reporting frameworks.
Probably
Gillian, can I? Sorry, go ahead. Well, I wouldn't mind just, Gillian, just adding an additional comment to the last question and Kaz's. There is nothing nuanced about boards needing to be on top of their appreciation of climate risk and to build it into their strategies. That is now a given, it seems to me, and will become further entrenched as we get on to the next topic that you've asked about. In terms of the transition risk and binary decisions, divestment has not actually saved 1 ounce of carbon emissions. I think it's a much more nuanced approach to that. And the additional feature of it, rather than ghettoizing those entities that you consider to be emitters and culpable thereby, is actually to look at directing one's investment into renewables and other aspects. So the point is, it's a long and tortuous path. The need to be on that path is clear and unequivocal. But the direction that path may take has got multiple prongs to it, if I can put it that way. Laura, over to you. I apologise for interrupting.
Sorry, just on the transition risk, I think as well, for my 2 pence on that is the real challenge, I think, is the timeline, and dependent on which jurisdictions your company is operating in. I think when we look at the UK as an example, the UK government and its climate change and green strategy has bipartisan support, and one would expect that the timeline which is currently being articulated probably isn't going to be subject to major changes going forward. But you compare that to other jurisdictions and the position is much less clear. Again, taking the question around framework, there is certainly a giddy array of potential frameworks out there, all posed on a voluntary basis, and numerous guidance around that from government entities, agencies, interest companies, activists. The UK government has pinned its flag to TCFD, and I can't see that is going to change. But of course, that in and of itself is is developing, and the guidance around it is developing. And at the moment, it's a comply or explain for certain entities, but it's been made clear that the government wants it to be mandatory. But again, you look at another jurisdictions, and it's not so easy to say how it's going to play out across the board. Obviously, there are centralised assessments at the European level around disclosures and having a proper taxonomy around the language and the disclosures used. So that's one thing. But in other jurisdictions, there's still everything to play for, and it's hard to say.
We are coming to an end, and I'm going to ask quite a complex question, which is probably a very big mistake. But just on scope, you've all alluded to it in different ways. And obviously, one of the things that climate change is forcing companies to do is to think perhaps beyond the narrow scope of the legal entity to the supply chain and a much broader sort of ranging up to scope 3. How well equipped do you think boards are to be thinking, and Simon touched upon this to a certain extent in that sort of holding company and subsidiary, but actually, you know, with climate change, we're thinking about influence way beyond the narrow legal entity. And I'd just be interested in kind of maybe a snapshot view. How well equipped do you think boards are for this deeply complex topic? And also, you know, how does one influence beyond the legal entity? So I don't know, perhaps either Simon or Laura, if you wanted to perhaps pick that up.
I mean, very, very quickly, I don't think there's any getting away from the fact that the metrics and the data within organizations and benchmarking across organizations is just growing and developing, and will continue to grow and develop. So I think that, you know, the concept of getting it completely right in the same way as getting an audit completely right is probably misleading. All you can do is do your best and in good faith with expert support. Secondly, those that started that thought process in terms of looking at scope 1, 2, and 3 will be better equipped over time to get it right, and they'll be at the vanguard. And I suppose that's the point, really. The sooner you start engaging in those thought processes, the bigger the library and bank of data that you have, the better you know your organization and your supply chain, the better you are at disclosing it, and the more you learn. There's a cottage industry growing out there, quite rightly, to support corporates in doing that, and of course there'll be winners and losers within that too.
Thank you very much. That was a huge question and a complex question, and I think that's a very good answer. That good faith, that this is a developing sector and challenge, and so boards need to be doing their best, and demonstrating that they are doing their best is probably a fundamental takeaway from today's webinar. I'd like to thank our speakers for joining us today. Amy, if we could just go back to the final couple of charts, please. Really, we've taken the sort of the liberty of concluding before listening to all that our speakers had to share with us. But I think, you know, very much supporting that climate change competence is becoming an essential board skill. Net zero can only be achieved with major corporate support and innovation. And boards are part of this, governance is part of this. And then finally, board directors do need to be vigilant. Failure to act or misleading reporting are not without consequences. And I hope that in a nutshell, those are some of the takeaways from today's webinar. If we move to the next chart, please. Just looking ahead, our next couple of webinars will also have a very strong both ESG and climate change component, and in particular perhaps with the outgoing chair of SSE, Richard Gillingwater, where we'll be looking with Chapter 0 at the contribution of the chair and the role of the chair with regard to climate change. And I'd like to just take this opportunity to really thank all our speakers, Simon, Laura and Kaz, for what was a canter, and I do apologise for having to cover so much territory in such a short period of time, but I think you've done an absolutely sterling job. We have a number of questions about particular documents or references that you've made, and so what we'll do is collate that and send it to all those who participated in the webinar afterwards. So I'd like to thank everybody for your participation today. I would have been interested actually to know whether we were still at 61%, that boards felt that, that participants felt their boards were well prepared for climate change. I'm glad to hear that, and I hope that still is the case. I think Simon ended on a positive note, which is important, and that's fundamentally where we stand as well at Fidelio. We'll share the charts with you and the references. Thank you very much indeed for participating, and we appreciate your engagement, and thank you to our speakers as well. Thank you.
Thank you.
Bye-bye.